Blue Chip Bulletin. Financial market updates and insights.
Today, we are breaking down a really big moment for one of the world's most legendary companies. Berkshire Hathaway has just dropped its first major financial report of the post-Buffett era, with the new CEO Greg Abel in charge. And wow, the numbers tell a really fascinating and kind of complex story.
So the first thing that just jumps right off the page from Berkshire's fourth quarter report is this number. Operating earnings. That's the metric the company itself says is the best way to measure how they're doing. Took a nearly 30% nosedive compared to last year. Yeah, that was a clear miss, and it definitely got headlines buzzing and raised a few eyebrows.
But at the same time, you have this totally different figure, a record-shattering cash pile. Berkshire is now sitting on over $373 billion in cash and T-bills. So what's the deal here? Is the company struggling, or is this a fortress just getting ready for its next big play? To figure that out, we really need to get to know the new captain, CEO Greg Abel. This quote from his very first letter to shareholders kind of sets the tone, doesn't it? He's all about the long term. He's not trying to fill Warren Buffett's shoes, but he is promising to build on that incredible legacy.
All right, so let's get right into this first report under new leadership and see what it tells us about where this trillion-dollar empire is headed.
You know, the one question on every single investor's mind is simple. Does the magic keep going? For decades, Berkshire Hathaway was Warren Buffett. Now the market is watching Greg Abel's every move, trying to see if he can steer this giant through a totally new economic world.
But you know, before we can really look forward with Abel, it's actually crucial to look back at one of Warren Buffett's final, absolutely brilliant moves. It's still paying off in a huge way, and it's just a masterclass in how he thought. Let's talk about Japan.
Now, the pure genius of this strategy is it's something else. While almost everyone else saw Japan as a place of economic stagnation, Buffett saw incredible value. He pulled off a classic arbitrage play. He borrowed money in yen for less than 1%, then turned around and bought shares in Japanese companies paying out dividends of around 4%. And here's the best part. By borrowing in yen to buy assets in yen, he totally insulated himself from any currency risk. It was just a low-risk, high-reward move, plain and simple.
But for Buffett, it was never just about the numbers. He really genuinely admired the corporate culture there. In his letters, he just raved about Japanese management, how disciplined they were, how they focused on steady returns for shareholders, and how they kept executive pay in check. It was a style of governance that just clicked perfectly with Berkshire's own philosophy.
So how does that legacy of discipline play into what Greg Abel is doing now? Well, it's clear he's sticking to that principle, but he's bringing his own playbook to the game, and it's all about operations. This chart gives you a great little snapshot of Berkshire's diversified power. It breaks down the Q4 operating profit. And you can see the two main engines chugging along. Insurance underwriting pulled in $1.56 billion, and the BNSF Railroad brought in $1.35 billion. So even with that big drop in overall profits, these core businesses are still just printing cash. And right here, this is where we get a really clear signal of Abel's whole philosophy. This quote is a direct message to Wall Street. He's not interested in just getting bigger or chasing market share at any cost. For Abel, disciplined, sustainable profit from underwriting, that's the only game that matters.
And you gotta hand it to him, he's being super upfront about the challenges. He's pointing out that after a few good years, tons of cash is flowing back into the reinsurance market, and that's pushing prices down. He's literally warning shareholders that Berkshire is expecting these headwinds to stick around through 2026, and that they will absolutely write less business if the price isn't right. I mean, that's textbook discipline over volume.
And this right here, this is the perfect example of his pragmatic approach in action. On one hand, you've got Kraft Heinz, a long-time holding that's been a real underperformer. Abel's already signaling a much cooler data-first approach, basically saying he's ready to cut back or even sell it off. Now contrast that with those Japanese trading companies, the high-performing, well-run assets we just talked about. Abel's made it crystal clear he's ready to put more money there. It's a hybrid approach. Stick with the winners, but don't be sentimental about the losers.
This focus on discipline brings us right back to the giant elephant in the room, that massive, record-breaking mountain of cash.
So, the big question for any investor is, why? I mean, is this a sign that a company this huge has just run out of big ideas? Is it a huge missed opportunity in a market that's been going up? Or is there something else going on here?
Well, Abel's answer is crystal clear. This cash isn't a problem, it's a feature. He calls it strategic dry powder, basically a war chest that lets Berkshire strike with overwhelming force when everyone else is panicking during a market downturn. And this strategy is backed up by outside analysis, like a high 4 out of 5 resilience score from Smart Karma, which says holding a big reserve makes sense given those insurance headwinds he talked about. He's positioning Berkshire as a pillar of the financial system, ready to jump in when it's needed most.
So, you've got a new captain, a clear strategy, and a mountain of cash. What's it all mean for the company's valuation? What are analysts thinking about the stock right now? First, let's circle back to the most important number here. Both Buffett and now Abel have told investors again and again to ignore the headline net income number. It swings around like crazy because of the paper value of their stocks. The real metric, the one they care about, is operating earnings, the actual profit from their businesses. And that 29.8% drop is what management themselves will be laser-focused on turning around.
So when you look at the stock itself, analysts seem to think the market has it priced pretty much spot on. As of February 2026, the price was just under $500 a share, with an estimated fair value around $510. So it's seen as trading almost exactly where it should be. That tells you there's no big discount, but no crazy premium either. The market is basically neutral.
And these numbers, they really tee up the central debate about the company's future value. You can see the market is pretty much in a wait-and-see mode right now.
And this is it right here. This is the debate boiled down. Are you investing in Buffett's legacy, that legendary patient value-first philosophy, or are you betting on Abel's new mandate, a relentless, pragmatic, data-driven mission to wring every last drop of efficiency out of Berkshire's massive empire? The future of the stock really depends on which of those two approaches creates more value from here on out. And you can see this exact debate playing out in the analyst ratings. I mean, look at this. There is no consensus at all. The biggest group, 50%, is just sitting on the fence with a hold. And the rest are split right down the middle between buy and sell. The market is totally divided, just waiting for Greg Abel to prove that his new playbook can really deliver.
Which leaves us with this final, really important question. Warren Buffett built Berkshire into a giant by being the greatest capital allocator, maybe ever. But when you're already a trillion-dollar company, maybe the next big growth story isn't just about smart investing, but about perfect execution. Is Greg Abel's intense focus on operational efficiency the new, necessary formula for creating value at this incredible scale? His first year at the helm is going to be one fascinating test.